Hello and welcome to Market Domination. I'm Julie Hyman. That's Jared Glickreed in for Josh Lipton today, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The question really is, number one, can AI companies that are building these models like Google, like OpenAI with their partnership with Microsoft, can they eventually generate revenue that makes this investment justified? I think they will. The second question, to your point, is can Nvidia maintain its dominant position, providing the brains to these artificial intelligence models? And I think they can.
You get a lot more leverage with Nvidia because really any interest rate announcement really affects Nvidia with such a high PE, as we heard from the earlier guest. The earnings are so far out that any change in expected interest rates really affect the price. So you could get some very large moves.
We need to see a run of weaker data on inflation and the labor market for the Fed to be confident enough to cut rates in September. And we don't want to over-exaggerate this point, but of course, making a decision to cut rates ahead of the presidential election probably means that they need to be very, very convinced. They need to have very clear evidence that the economy requires those cuts. So if there is any kind of doubt, any hotter than expected inflation data, then unfortunately that does probably push out that likely date through to the end of the year, if not 2025.
We've got 1 hour to go until the market close. So let's take a look here first at the major averages here. We've got a mixed picture today. Really, we are focusing more, it seems like traders are focusing more on tomorrow's jobs report versus anything that happened today. We did get weekly jobless claims coming in this morning, not too far off from what economists were estimating. But you see right now the Dow up about 79 points, about 1/5%, but the S&P 500 very slightly down, and the Nasdaq Composite down about 0.1% as well. Let's check on over with bond yields as well, which we continue to see pulling back 4.28% now. But again, we're not seeing that consistent lift to stocks from bond yields kind of hovering at these relatively low levels. So let's check on some other things that we've been watching in this market that have been getting attention. First up, we got to talk about what's going on with Nvidia. Now, yesterday, of course, the stock hit that $3 trillion market cap milestone and a record. But today, because it is not still at those levels, because it's lower on the day, it is back below $3 trillion in terms of market cap, and that also means it is now smaller than Apple at this point. The other thing we want to check on is, we thought the meme trade was going away again. Nope, not going away again, because guess what? We've got a GameStop back in our sights today. We're going to talk about it later, but it once again has to do with a post. Not even a post, but an impending post from Roaring Kitty, a.k.a. Keith Gill. So we're going to talk about that in just a few. The shares up 56% over 2 days, but on the single session, up 32%. And you see where his post about a post appeared on the stock chart. Jared?
Thank you, Julie. Investors on edge with the major averages. Little change in today's session ahead of Friday's monthly jobs report. Also playing into the weakness, the euphoria over Nvidia's $3 trillion market cap fading a little bit. The stock down to about 2% with an hour left in the trading day. Joining us now is Jeremy Schwartz, Wisdom Tree Global Chief Investment Officer. Jeremy, thank you for joining us here. We've got a lot of news to dissect, including an ECB decision and the big labor report tomorrow. But investors want to know about AI, and we got this big Nvidia stock split tomorrow. Let's just tackle that first. What are your thoughts here?
We're very much believers in the AI story. We think the technology is really going to help the economy. I think we're so early in the phases of that transfusing through the economy. So you got to see, it's going to have big impacts on interest rates and productivity, what that's going to mean. So we're believers. Now, the question is Nvidia going to be the only winner is the real question. They've been for sure the best winner as all these big companies make investments in the chips, and they are for sure critical today, as you keep talking about. But we do think there'll be broader participation. We think more companies will benefit And so as you look ahead, you could say we think there will be a broadening of the rally, but we're believers in the technology, and we don't think that tech is in a bubble like 2000. You hear a lot of people worrying about valuations, and we don't think they're at 2000 levels. We actually think tech as a whole is only half the multiple of what it was in 2000, and much more reasonably priced than it was back then.
Well, so why expand a little bit upon why you don't think it is in a bubble?
Well, back then you had 9 stocks, triple-digit PEs. Some of the largest stocks, the S&P 500, had hundreds of PE ratios. Cisco in the hundreds of PEs. Nvidia is expensive, but it's still around 40 times next year earnings. So it would be considerably higher at that sort of Cisco in 2000 type levels. Now, so the S&P as a whole, the S&P tech sector was well in the 60s. Today, you're 60 times forward earnings. Today, you're 30 times forward earnings. So yes, it's more expensive than, say, the non-tech. Call it the non-tech might be at 17, 18 times earnings, and tech is at 30. But they're growing their earnings twice as fast. The projected earnings even are growing twice as fast. So, when you look at the long-term next, call it 3 to 5 years earnings growth for the tech leaders, over twice the growth rate expected than the non-tech. So that multiple premium is warranted if they can deliver those earnings. If they really have a slowdown in earnings, then obviously there'll be some correction there.
All right, want to switch gears here, go over to the ECB. A lot of eyes on this decision because it comes a week ahead of the big Fed decision that we have next week. And Europeans, as investors thought, this was no surprise, they cut, and they cut first. But it's about the forward guidance, and I'm just wondering what you parsed out in some of the commentary surrounding this.
I mean, it's interesting. This was the first time the ECB has cut before the Fed. I mean, so that's a big new statement as well. Even if it was expected, often people think of the Fed leading, the ECB following. I think it's some elements of, well, maybe some of the global inflation pressures are coming down. They're not pre-committing to any further cuts, but they're going to have to see the data as it comes in. They're all talking data dependence, of course. But it actually comes back to this whole role. We think what the implications, you have interest rates are implications, but currencies are implications. I wonder about the euro. It adds to a lot of volatility investing in Europe. I say you should think twice about that. You should think more about the stocks being cheap, not necessarily when you go long the euro. And the sort of cutting of rates, I think, is another part of that. Sort of Fed staying tighter than the ECB in some ways is supportive for that. But just why bet on the euro? The stocks are cheap. What's the expected return from the euro? I'm not sure I'd be chasing it with the ECB cutting here.
Speaking of chasing, though, are there any implications with the ECB going first for the Fed?
Well, it's just a sign that rates, that inflationary pressures are coming down. You heard the Bank of Canada also cut rates. And, in some of the commentary is just that we don't need to be as restrictive as we had to be in the past. And I actually think that's true for the Fed, too, that inflation's coming down. They don't need to be as restrictive. Now, the question is, can they say the data is coming enough that they have confidence that inflation is well on its way down? We have some alternative measures of inflation that look at what's happening in the real-time housing markets. That would tell you they're right on track for 2% inflation. And so if they could just take that broader view, you would say, hey, they don't need to be as restrictive either. But it comes down to what is the data they're watching and do they have that confidence?
It's been a really interesting week in terms of international developments and also election results. We got 2 surprise election results over in India. We had a much closer race than anticipated. In Mexico, we had some volatility surrounding the end of the decision there. In India, we have Modi remaining in power, but he has a reform agenda. And I guess the discussion is he going to be able to enact more reforms given the fact that he doesn't have the lead that he did before? How are you viewing Indian equities now? And then could you place this in relation to the growth story that was China several decades ago?
To me, India is still one of my favorite long-term growth stories over not just coming years, but coming decades. It's got one of the best demographic profiles. They have expansionary goals. Modi still wants to become a developed country by 2047, their 100-year anniversary. And they've got potential to do that. Now, they've got sort of tailwinds of the young population. There was some volatility this week as people tried to react. Is he going to actually get what he needs to do? But you got to remember, his reforms are still in place. These people are not coming in and overturning his reforms. A lot of what he accomplished in his first 2 terms are in place. They're not going backwards. They've got a good tailwind behind it, and he still has a coalition there that's going to help him get even further reforms done. So there was volatility, but we still love India. We think the growth outlook is there. And I think there's still a strategic repositioning away from China. People have been trying to time the bottom of the Chinese, you could call it despair, as from their economic doldrums, and then the markets have really been under pressure the last three years. But I think people are moving away from China strategically. India has been a beneficiary. Japan is another beneficiary that we like a lot from a valuation perspective. And I don't see any of that changing.
And Jeremy, to close us out, let's take it back here to the U.S. I mean, you talked at the top a little bit about the AI trade and growth stocks generally, but how are you sort of thinking about U.S. equities right now and how much more upside they might have given the economic backdrop and the backdrop for the Fed?
You know, the S&P 500 is around 21 times earnings. That's a 5% earnings yield. You could add 2 to 3% inflation on top of that to get 7 to 8% as your outlook over the longer term. I mean, there's certainly pockets that are well below that 21 times. You could look at small caps at like 12 to 13 times when you look at them the way we do with profits or dividends as part of the screen. But they've been really needing the rate cuts. You know, until you really see rates coming down, it's been tough for small caps who are more reliant on bank lending and sort of that they're paying the higher cost of the Fed. So I think there's some opportunity. I say look beyond just Nvidia as the only beneficiary. We think that broader participation would include things like the small caps. But, you know, the overall is at a reasonable price. You know, the long-term bond, the TIPS yields are only 2%. So you still get a nice equity premium for stocks versus bonds. But you can say, hey, look for some of these other opportunities when the Fed starts cutting.
Jeremy, good to see you. Thanks a lot for joining us.
Thank you so much.
We want to check on shares of GameStop here. They are soaring today, as we talked about earlier, some 40%. Trading got halted several times in the last hour and a half or so because of volatility. And what was the catalyst? Well, guess what? It was Keith Gill again, also known as Roaring Kitty. He posted on YouTube. He didn't really post. I mean, it's sort of a post. It's going to be a live stream at noon tomorrow, right? Basically, all this post says, it's sort of a very memey placeholder screen here that says there's a live stream he's going to be doing that he hasn't done, in 3 years' time now, starting at noon tomorrow. Again, noon on June 7th. And the commentary, you know, there's of course the comments box on YouTube, has not stopped. There's nothing to look at yet.
I'm looking at it right now on your screen.
It hasn't stopped. Yes. It's just scrolling constantly, people commenting before he's even said a word.
Yes, and I mean, he has the capacity to do that. If we go to the Wi-Fi Interactive, I'll point out a couple interesting things here. This is a $15 billion company, and check out the PE ratio. We're talking about eye-watering levels from the dot-com era, 2,232. That's just really high. But let me show you what happened in the chart. This is year to date, and what stands out are these big spikes here. And here's another one. And this kind of reminds me of what happened in 2021 because this is much more compressed, but there was some space. We'd have an episode, then we'd have a few weeks rest. And you know, maybe it's tied to the option schedule, maybe it's tied to something else. And there was all kinds of speculation. How much had the traditional Wall Street, like hedge funds, infiltrated Reddit. But Keith Gill has been conspicuously silent. He's posted some things, but he's been silent, and now he gets to speak. So I'll be watching it. And
I wonder if he's spoken to a lawyer before he is speaking to us, because, of course, as we know, the Securities and Exchange Commission is reportedly looking into his recent activity. Remember, he's
moving the market. So.
Yeah, I mean, he posted a screenshot that says he owns about $116 million worth of GameStop shares, which would make him one of the largest holders. We'll see what he's going to say about all of this.
Yeah, and I mean, just to be clear, it's not against the law to talk your book, but you can't lie about it. So he'll be in the crosshairs, but maybe we hear a little bit of
looking forward to it.
Tomorrow.
And so is everyone else, apparently. We're just getting started here on Market Domination. Coming up, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deep dive into 2 stocks to help you make the best choices for your portfolio. And our own Josh Lipton sat down with Palantir Technology CEO Alex Karp to discuss the company's AI platform, defense spending, and more. We'll have part of that conversation coming up at 4:45 p.m. Eastern. Now for a look at some trending tickers. First up, JM Smucker, the company reporting earnings that came in way above analyst expectations. The shares up by some 4%. The news of these earnings has sparked a very large discussion and debate in the newsroom today about peanut butter, about jelly,
And the key,
about almond butter. Oh, please tell me.
Uncrustables. People are very passionate about this food stuff, and so I got a crash course in it. Although I'd heard about it tangentially over the years.
Have you ever had it? You've never had an Uncrustable?
I have not.
I have, but I prefer not to. Is how I feel about Uncrustables.
Anyway, it seems like love-hate is kind of the relationship.
But a lot of people like them. That's one of the reasons that the company did well last quarter. Apparently, that was one of the things fueling the sales.
Yes, and I got a couple notes here. Here's one from Stifel, rates a stock a buy. Fiscal year 25 guidance likely better than feared, so kind of a low bar, including a step up in investment behind Uncrustables. There you go. Furthermore, indication that fiscal year 2026 should be above algo and should support stock outperformance amid low investor expectations into the quarter. And the algo they're referring to is their internal growth algorithm that they use to, everybody models growth if you're a company. The sell side does it too, not exactly the same way, but there you have that. And then D.A. Davidson rates the stock in neutral, saying fourth quarter results were, here's another one, better than feared, benefiting from stronger than forecast gross margin, offsetting the sales miss. Still, quote, given where sentiment and valuation stood ahead of the print, low, the stock should be up this morning. And just taking a quick look at the Wi-Fi Interactive, been kind of a rough year for staples overall. And here you see the stock, Smucker, trailing the market by 9%. And I do like to give the entire pandemic view, and you can see trended up until the beginning of 2023, and then kind of got knocked down during the bull market as other stocks rose.
Well, they did a bunch of stuff, right? They bought some stuff, they got rid of stuff, they bought Hostess brands, but they divested some other businesses. And sales overall were down, but it seems like Hostess is something that performed relatively well for them. So we'll keep watching that.
All right, we are also watching shares of Rivian, the company unveiling its updated R1 pickup truck and SUV. Pras Subramanian is here with the details. So what's behind this latest model?
Yeah, so the R1 truck's been out for a while and due for a mid-cycle refresh. So some pretty big things under the hood here. New motors, they're building their own in-house motors for their quad motor and new tri-motor vehicles. That's pretty exciting. We're talking about over 1,000 horsepower here. Redesigned battery modules, they're more efficient, simpler to make. And this is all part of the kind of big push here to make these cars cheaper, but not sort of ruin the experience or make the cars lesser than what they were before. So this is the kind of the big trick. Can they actually, do that, right? Make these cars actually profitable. And they need to bridge that kind of road to 2026 when the R2 comes out, the new vehicle. Can they become, I think it's variable profit, gross profit by then, and be in a good spot for where they can kind of ramp up with the R2 vehicles?
Well, it looks like there's a little bit of optimism around at least where the shares are how they're reacting today. Let's talk about another trending ticker that you're watching in your space, and that is NEO, which came out with results that investors did not like. Yeah,
stock down a bit here. Missed on both the top and bottom line for their Q1. Guidance wasn't so bad, but just really quickly here, NEO lost, converting to dollars here, 33 cents a share, wider than expected on revenue of $1.372 billion, down 5% compared to a year ago on around deliveries of 30,000 units, which is down a lot compared to Q4 sequentially and 1,000 units or so down from last year. But for Q2, seeing 54,000 to 56,000 deliveries, that's nice to see that. And revenues of 2.3 to 2.37 billion US dollars, better than the 2.1 billion estimated. So Q2 looking better, but I guess there is some concern here. The Q1 numbers weren't that great compared to Q4 sequentially, so maybe that's why we're seeing that stock not doing too well here.
Yeah, and there's a lot of competition in that market. Okay.
Indeed.
Thanks, Pras. Appreciate it.
All right, Nvidia hitting $3 trillion in market cap for the first time yesterday, becoming the second largest U.S. public company behind Microsoft. Although we are seeing a pullback, just a small one today. And with Nvidia's 10-to-1 stock split coming up tomorrow, we may see another surge in short selling and options trading. For more, we are bringing in Ihor Duzaniski, Managing Director at S3 Partners. So let's talk about the short interest that we're seeing here, the main story. What's your big picture view?
Well, Nvidia's is the largest short in the U.S. market with $34 billion of short interest. It's climbed to the top over Apple and Tesla. People are shorting it based on being a momentum stock and also a hedge to the market and a hedge to the tech side of the street. So we're seeing a lot of activity, and there's something to be said about people shorting ahead of the stock split.
And what does that say? What does it say that they're shorting ahead of the stock split? I mean, I have seen some research that indicates that, say, in the 12 months on average following a split, that stocks tend to perform relatively well. But obviously, if people are shorting it, that would imply they don't believe that in the short term, at least.
Sure. Over the last 30 days, we've seen around 1.6 million shares shorted. It's around $2 billion, so it's not a light figure. This includes option trading, because you've got the hedges to the people that are writing options. They take the hedges out and they short stock in order to protect themselves against their open option positions. But really, this ends up being kind of like playing a roulette wheel, red or black. Do we think that the run up in Nvidia has kind of taken up all the sale and its wins temporarily for this stock split, and we're expecting a pullback afterwards, or is it just basically the start of a bigger move after the stock split? So you got to see who's on each side of the market. And we're seeing a lot of shorts betting for a downturn.
I want to ask you about GameStop here, another ticker that's in the news. We were talking about Roaring Kitty, Keith Gill, finally talking to the market, talking to the public tomorrow. What kind of short interest are you seeing in GameStop ahead of this event?
Well, it's things just keep coming around in the market. We've got $2 billion worth of shorts interest in GameStop. It's one of the largest shorts in the computer and retail sector. There hasn't been that much short selling recently. There's been around 1.3 million shares shorted for the year, around 2 million shares bought to cover over the last 30 days. There's been a short squeeze in the name. So we're seeing some pullback in the stock. I mean, you got to look at the price moves and say that the shorts are getting walloped today. I think they're down around $640 million just on today's stock price move. That brings year-to-date losses to around 1.4 billion. So this has been a painful trade on the short side, and we're seeing a lot of shorts get out of the market.
Well, and that's what's interesting to me as well, Ihor, because I've seen some chatter recently that it's not just shorts that are getting out of the market with something like that, that generally in the market there is lower short interest now. Are you seeing that in your data also?
Not really. We're seeing that the short interest has actually gone up over the last 30 days. Overall, we're seeing around $1.15 trillion of short interest. It's up around $25 billion over the past 30 days. That includes the mark-to-market interest increase of the price of the stocks being shorted already, but also it's another $11 billion of short selling. So there's discriminate short selling in the market. Certain sectors are seeing a lot of activity, others not so much. We're seeing increased shorting in the tech sector. We're seeing short covering in energy. So the people are rotating in and out of sectors, but generally short interest is still up.
I'm wondering if you have some kind of market timing model that's based on your own analytics and maybe based on maybe it's a contrary indicator, but do you aggregate the short positions and then try to divine, all right, is the market going, is it reaching a peak, is it reaching a valley, anything along those lines?
Yeah, that's not something we do to predict the pricing in the market. What we are looking at is what the street is doing, and when you look at it, a lot of the short selling or most of the short selling is done by the big institutions, hedge funds, and such. So you kind of look at it and say, okay, what's the quote unquote smart money doing in the market? You'll be looking at stocks that they're looking to short for profits for an alpha trade, and you're also looking at shorts that are used as hedges. So 12% of the entire short book in the U.S. is in Mag 7 stocks. So you've got stocks that are looking shorts that are looking at those stocks to go down, and also they're using it as a hedge to their entire portfolio. But right now, we're seeing shorts increasing their positions.
And finally, there's one more stock I wanted to ask you about, Ihor, that caught my eye on your list, and that is MicroStrategy, because most of the other stocks that are on this list are mega caps. MicroStrategy not really in that category. It also stands out because 21% of its float is shorted, which is quite a high number and one that, again, sticks out from the list. So what have we seen for the numbers there? Is that a recent development, or has that been pretty consistent?
Yeah, well, just kind of to give it perspective, the average short interest percentage of float is 4.8 for the U.S. market. So we're talking about 4 or 5 times the size of the normal average short in the market. MicroStrategy is kind of a twofold bet. It's a Bitcoin bet. So you want to short Bitcoin, short MicroStrategy. It's a much more liquid stock. You can get in and out of the position as opposed to going in and out of Bitcoin itself. or paying a premium in these ETFs. So you know what? A lot of shorts are saying, yeah, I'm going to short MicroStrategy instead of a cryptocurrency bet in the market.
Proxy trade, love it.
Exactly.
And thanks for all of this very elucidating information here, Ivan IXIC. All right, coming up, it is the latest edition of our series, Goodbye or Goodbye. We're going to take a deep dive into 2 stocks to help you make the best choices for your portfolio. Stay tuned. More market domination after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at 2 stocks with very different performances over the past month, but don't be fooled by short-term gains or losses. We're taking a look at the longer-term trends that will move these names over the next long term. I'm here with Vance Howard, CEO and Portfolio Manager at Howard Capital Management. Good to see you.
Hey,
Thanks
how are
for
you?
being here.
Thank you.
So let's start with the stock that you like, your Goodbye, and that is Salesforce. Now, Salesforce actually has risen over the past year or so, but then as we can see here, it has had that dip over the past month. So why do you like it, or you think it's actually oversold because of that dip?
Well, you look at a technical thing, and you look at a stock that drops 20% in one day. That wasn't your retail sellers, and in all probability, it wasn't your money manager. That was quantitatively driven for that much selling to happen that quick off that little piece of news. Salesforce is a wonderful company, wonderfully managed. It had just a slight hiccup in earnings and revenue, which is, it can be overcome. But if you look at the long-term effects of what Salesforce is doing as far as what AI is going on with AI, the fact that you're buying down here on a dip, as far as being an intermediate to long-term investment for investors, this is a great stock.
Talk to me a little bit more about that growth with AI, because it seems like one of the disappointments around the earnings for some investors was that it's not yet, I don't know, squeezing the juice out of that one yet, so to speak.
Well, you got to remember with AI, let's put it like on an 18-hole golf course. With AI, we're on hole number 1. So there's a long way for everybody to go, including Salesforce. But if they can bring Salesforce in over the next 12, 24 months, 36 months, and all of a sudden you reduce overhead by 10, 15, 20%, your earnings are dramatically going to go up. So if you're looking at a great long-term buy, I think Salesforce is the play. And I love recurring revenue.
Yep, let's get to that one. I mean, that's really the holy grail for most of these software companies. They want to have that subscription revenue. So you think it's working for Salesforce?
I think it's working great. And you know, Salesforce is not an easy tool to learn. So most people we have it at our office, by the way. It's not an easy tool to learn. So once you've educated somebody on how to use Salesforce, they're usually going to use it from here forward. It's an incredibly robust tool. We use about 20% of what they've actually built into the software. There's a ton we don't even use that we haven't learned about. It's that robust and that healthy of a piece of software. So as we start to grow, as the economy starts to come back and grow, inflation starts to drop, I think Salesforce at these levels are way oversold, and I think it's a great buy.
Gotcha. Okay, so what do you think could go wrong for Salesforce here?
I think what could go wrong is the economy, something that we can't see happen out there that nobody can really project or gauge or game. I think that could hurt the stock a little bit. Other than that, I think it's already washed itself out. I think that it's clean to go. I think you've hit it. It may come down to retest that low a little bit around, what, 216? And that's okay too. But right down here at these levels, I think it's a really good, strong buy.
Okay, well, let's get to the one that you do not think is a good, strong buy, and that is Spirit Airlines. Now, this stock has already tumbled a lot over the last year. It's down something like 75%, but it did have off a low base, but it had a little bit of a bump in the last month here. So why don't you like it? Well, I mean, they had a big piece of news with the merger falling through.
Well, this thing's falling apart. The debt level's unsustainable. They're losing revenue. In 2025, they're going to have 70 jets on the sideline for whatever reason being repaired or just out of service. 70. That's going to be a remarkable amount of air flights that aren't taking off with Spirit. It's a bad bet right now. In all probability, when you look at Spirit Airlines, it wouldn't surprise me in the next 6 to 12 months they're in bankruptcy. And that's not uncommon for airlines.
It is, although it has become less common, right? It used to be a lot more common. Is there another merger possibility out there for them?
They're going to let them die and buy them cheap at this point, because when JetBlue backed away, that was the tell. They're just going to let them die and come in if somebody wants to
get the
take
parts,
them up.
maybe.
Yeah,
okay, and you mentioned the growing debt load as well.
It's just exploding.
Yeah, is that also, you know, when you're shelving planes and not flying them, you still got to pay. You got to pay to park them, for example, right?
They're expensive. And to maintain them, you've got inspections that have to take place. You've got pilots that are on the payroll. You've got all these different factors that are driving up the debt that's unsustainable. Plus, you got revenues dropping and incomes dropping. And if you're losing a couple $100 million, it gets pretty unsustainable quick.
Yeah. So, I mean, not surprisingly, you think it's a high-risk buy here.
I think it's a void at all cost.
Yeah. Gotcha. All right. So what could go right here? Maybe they could raise some capital.
Maybe a buyout. I think that's it. That is the one thing that they need to look at, is they have some savior come in and pick them up.
Gotcha. All right. So, and just quickly here before we leave you, you own Salesforce?
We do.
I'm guessing what you're saying. You use
Salesforce. We own it.
You use Salesforce at your office, and you own Salesforce. Are you short spirited in any way, or you just don't own that
just
one?
Avoid.
Avoid it. All right, Vance. Thanks so much. Appreciate it. Thanks for coming in for Goodbye or Goodbye, and thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
And on Tuesday, CrowdStrike Holdings delivered first quarter earnings that beat Wall Street's expectations, despite a pullback in spending that has challenged many of the cybersecurity rivals. Joining us now to discuss further is Michael Sentonas, CrowdStrike president. And Michael, thank you for joining us here today. Just give us your big picture overview of your results, please.
Yeah, we had a great quarter. Ending ARR finished at $3.65 billion, which grew 33% year on year. Net new ARR in Q1 was $212 million, and free cash flow was $322 million. It was 35% growth year on year. So all in all, very strong, especially when you look at free cash flow rule of 68.
Let me ask you about Charlotte AI. This is fascinating to me because, the story of the day is probably Nvidia, and so everything is AI centric now. But how do you bring conversational AI into the cybersecurity realm?
Well, we know in cyber there's a massive skill shortage. We know that it's a complex area, and attackers are getting smarter every day. So we've spent a lot of time, really different to a lot of people in the industry in our sector. We're thinking about how do we use AI to accelerate the time it takes and like a defender to defend against the latest threats and techniques from adversaries. We know the adversaries are getting faster, so we need to use AI to help the defenders get better and make it easier. We need to make cybersecurity something that the average user, the average level 1 analyst can get their hands around and give them a chance to protect themselves. And that's what we're doing with Charlotte.
And Michael, it's Julie here. So when you look at these numbers, is it a factor of you all taking market share from competitors? Is it a factor of you getting more business from existing customers? What helped you grow last quarter, and what's going to help boost the numbers going forward?
Well, I believe we're doing both. And if you look at the deals that we have with greater than 8 modules, that grew 95%. And what that's telling us is that the Falcon platform, the CrowdStrike Falcon platform, has become the platform of record in the cybersecurity industry. Customers are telling us that they want to do more with CrowdStrike. They are buying more modules. They are deploying more of our capabilities, and they're turning off other workloads, other products from other vendors. And we're seeing that happen more and more.
And Michael, you mentioned Falcon. I saw a lot of talk about Falcon and Falcon Flex in the call. What can you explain to us what that means when you talk about that platform, and how is that different from what you all had in the past?
Well, we have 28 modules today. So the platform has grown tremendously over the last few years. Customers are telling us, as I said, they want to do more. They want to buy more modules. They're also saying, look, we know the quality of technology that you bring out. We know that you're going to come out with more modules. We know you're probably going to do some acquisitions. Help us buy more from you and make it easier so that when you do come out with a new module, we don't have to keep going back to procurement. We don't have to keep going through complex procurement cycles. So Flex gives our customers access to all of the products. It gives them the best possible price because they're committing to do more with us for longer periods of time. And we're just making it easier for them to get the best product in the industry that's so easy to roll out, and they can do more with CrowdStrike.
What do you think about in terms of acquisitions, just not only the specific fields where you might want to go, but just your general strategy, how you're thinking about them?
Well, for us, it's important to make sure that we stay close to who we've always been, and that's to stop breaches and give customers access to technology that is the easiest to use. Like I said at the start, it's a very complex area, and there's so many products out there that are just too hard to use. And that chaos that an organization has to deal with because they're working with 10, 15, 20 different vendors, it's too hard. CrowdStrike is easy to roll out. You can get the product rolled out in a few seconds. So when we think about M&A, it's important to us that whatever we do, it has to be part of our technology stack. It has to be part of the Falcon platform. There are so many vendors that talk about all of their different platforms, but they forget one thing, and that is how to help the customer. They do 10, 15, 20 acquisitions, and effectively they make the customer into a systems integrator who's trying to make poorly acquired and poorly integrated technology work. So for us, if there's technology that's interesting, if there's a good business out there, but importantly, we can integrate it and it's part of our stack, it's probably a good fit for CrowdStrike.
And Michael, overall, can you give us sort of a temperature check on enterprise spending here? Because it feels like, at least in terms of what we've been hearing from companies this earnings season, it's kind of been all over the map. So what are you hearing? Are you hearing that even your clients who are still spending with you, that they're trying to sort of retrench or save money?
Well, the market's certainly tough. We haven't seen any change, whether it's positive or negative. The market has been the same for quite a few quarters now. But like I said, our customers are wanting to do more with us. And the reality is you only have to just look at the news to see all of the different attacks that keep happening. It's a pretty challenging landscape out there. And organizations are really worried about whether they're going to be compromised, whether they are going to lose intellectual property, whether they are going to have business downtime. So that's why we're seeing more and more conversations, but certainly the market conditions haven't improved.
In the first quarter, you had annual recurring revenue of $3.65 billion. What are your plans to maintain your growth trajectory for annual recurring revenue or even exceed the current growth rate?
Well, for us, it comes down to making sure that we continue to meet the need of our customers, and that's to stop breaches. It means that we have to continue to innovate and come out with technology that is best in class. We've released a lot of technology. You talked about Charlotte earlier, but we're solving IT challenges with Falcon for IT. We introduced data protection, a new module to help with data loss and data loss prevention. We continue to innovate with technology like Next-Gen SIEM. There's a massive opportunity to solve the Next-Gen SIEM problem that organizations have struggled. I should really say the data problem and the SIEM problem with more modern technology like what we have with Falcon Next-Gen SIEM. So we continue to innovate. Last year was a big year of innovation. We continue to focus on bringing out the right technology to help solve those problems and staying true to meeting the needs of our customers.
Michael Santonis of CrowdStrike, thanks for joining us.
Thank you.
Before we go to break, let's take another look at shares of GameStop, accelerating gains heading into the close. The shares at one point were up in almost 50%. They're still up about 43% right now. This all coming after Keith Gill, known as Roaring Kitty online, posted on YouTube. He'll be doing a live stream at 12 p.m. Eastern tomorrow. So we'll see what he has to say. First time we'll have heard from him directly and not just through memes and posts. More market domination straight ahead.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
As shoppers feel the pinch from inflation pressures, discount stores battle it out to entice consumers' wallets. Customers looking for budget-friendly prices has been a tailwind for some retailers, while others, like Five Below, feel the weight of a challenging macro environment. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Anthony Chicumba, Loop Capital Markets Managing Director, is joining us now for more. Anthony, it's always great to see you. Thanks for being here. So
thanks for having me.
So let's talk about the big picture for sort of the core consumer for discounters, first of all, because typically we're talking about lower income consumers, although sometimes other folks trade down there. So kind of how would you characterize that consumer right now, and how is that playing out with some of these discounters?
The low-income consumer is in sort of a tough place right now. On the one hand, they are working, right? Unemployment is still very low, and we're still seeing very good rent. They're still spending, but they're being more selective in terms of what they're buying. They're looking more for value, and they're concentrating their purchases much more on must-haves, right? Think consumable products, think food, cleaning supplies, health and beauty care items, and much less on nice to haves, in other words, discretionary items. And unfortunately for retailers, they make much higher profit margins on those discretionary items than they do on consumable items.
And Anthony, how does this translate into your view on any companies within the sector? Who do you like? Because I'm looking at our Wi-Fi Interactive, a heat map of discount retailers here. Ollie's Bargain Basement up 11% on the year. Everything else in the red, some of it by quite a bit. We got Dollar Tree down 20%, Big Lots down 63%. And although it matters more than the share price, what do you like in some of these companies?
So we have buy ratings on two of these companies right now, specifically Ollie's, which, as you said, is a year-to-date outperformer, and also Dollar Tree, which is more challenged, but is a kind of a special situation. So with Ollie's, I mean, they are clearly benefiting from higher income consumers trading down to their stores. And their stores, it's very much a treasure hunt environment, just significant discounts relative to other national retailers. Even if you're talking about Walmart, they've got this Ollie's Army where, basically they have a very, very large customer loyalty program. Those folks account for 80% of their sales. They do a lot of great direct marketing to them. So they're really hitting on all cylinders right now. Dollar Tree is a little bit of a different situation. They've continued to have problems with Family Dollar, which is a chain that they acquired back in 2014. Probably never should have acquired them, quite frankly. And that's where the difficulty is in their business. But the reason I'm optimistic about Dollar Tree is they just announced yesterday that they are considering strategic alternatives for Family Dollar, i.e. they're looking to sell Family Dollar. And quite frankly, they could sell Family Dollar for a bag of magic beans. It would be wonderful for their business. I estimate that, literally they can get almost nothing for Family Dollar, but just getting rid of, that albatross and also getting rid of those leases, you're probably talking about $170, $180 stock.
A classic be careful what you wish for situation. I well remember when they were battling with Dollar General over that asset, and they won it, I guess, Anthony. I put that in air quotes. So one of the things that you point out in your research that I thought was really interesting is that most of these so-called discounters actually price at a little bit of a premium in terms of the products in their stores to the likes of a Walmart, right? But maybe there's the convenience factor that works in their favor. But right now, is Walmart going to take significant market share from them?
So, our latest deep discounters pricing study, I believe the title was something to the effect of, deep discounters have 99 problems, but Walmart's pricing is not one, right? In other words, they don't have to be at price parity with Walmart, largely because they're just much more convenient, relative to Walmart, right? In other words, the Dollar General, it's going to be in your neighborhood. You can park right in the front of the store. It's an 8,000, 9,000 square foot store. You can get in and out pretty quickly. And most of those shopping trips are kind of a midweek shopping trip where you're looking to spend like $10, $15. Contrast that with Walmart. Are you going to save a little bit of money by going to Walmart? Absolutely, in terms of the products, but you're going to drive like 20 minutes, a half an hour. You're going to park way, a couple of hundred yards from the front entrance if you're lucky. You're going to navigate a 200,000 square foot store. Now, all that's worth it if you're making your weekly or bi-weekly shopping trip where you're spending $100, $200. Not worth it if you're only going to spend like $10, $15. So I do not believe on the list of issues that the dollar stores are having right now, I don't think Walmart makes the top 5. I'm not even sure if they make the top 10.
Anthony, I want to switch gears a little bit, and we're going to stick with retail here. I understand that you have some opinions about GameStop and just some of the incredible volatility we've been talking about here today, more halts, more increases in share price. We got Roaring Kitty speaking tomorrow. What do you think about all of this?
And the infamous words of I believe it was Al Pacino in Godfather 3, every time I get out, they drag me back in. So here we are. Like, we went back in the time machine. It's 2020, 2021. I mean, look, I'm going to keep this very simple, okay? Keith Gill is a fraud, and he needs to be investigated. The fact that this individual bought short-dated call options on GameStop and then tweeted for the first time in forever, knowing full well that, these Reddit, Wall Street Bet folks would then drive the stock price up. I mean, look, I'm not a lawyer. I don't play one on TV, but it is shady AF, as the kids say. And at the end of the day, like, all that's happened in the time since 2020, 2021 is GameStop's business has gotten worse and worse and worse, right? I mean, look at the most recent news, right? Microsoft will be coming out with Call of Duty on Game Pass day and date when they first come out with that, with that title, right? In other words, you don't have to go and buy the actual game. You can now play it on Game Pass. I mean, that is ruinous for GameStop's business.
Well, Anthony, isn't all of that kind of beside the point, though? I mean, and maybe it wasn't originally, right? Because Keith Gill originally did make a fundamental case for the stock.
Originally.
Yes. Now, all he's doing is posting memes, but, for the people who follow him, is it because they really think that GameStop is such a great company, or is it because it's kind of fun to do the whole thing? I don't know.
Julie, what are we talking about here? We're talking about memes, okay? I didn't go to Harvard Business School to try to interpret memes. It's just not a thing, right? I mean, look, I'll come back to what I've been saying for years. First off, it's wonderful that younger people are getting involved in the stock market. It's a way to build wealth over time. That is wonderful. I applaud that. But there's investing, and then there's this. I would call it gambling. I think that's at this point an insult to gambling. And it really makes me very uneasy when individuals like Keith Gill have figured out how to game the system, no pun intended, and take advantage of these individuals. That, to me, that's what it comes down to. I mean, we can have a debate about what is GameStop worth this, is GameStop worth that, is GameStop worth this other thing. But when individuals are doing things like this, it just makes me really, really uncomfortable. And quite frankly, I feel sorry for these individual investors who are just being taken to the cleaners.
Is there, what, I mean, I don't even know what to say, Anthony. I mean, there is this excitement, there is this sort of cult of personality, obviously, around Keith Gill, but I don't know. Are we taking it too seriously? I guess, I mean, I'm sure people lost money, the last time this happened. I'm sure they're going to lose money this time, but, is it? It's kind of, as you say, it's kind of on them. I don't feel sorry for them. They know what they're getting into, no?
I mean, that's a bigger philosophical discussion, right?
So.
It's fun until it's not fun, right? It's fun until, basically you buy a bunch of stock on margin, and now you can't make your mortgage payment, you can't make your rent payment, you can't make your car payment, right? And we always talk about, the folks that, make a lot of money from this, like Keith Gill. Like, we don't talk about that individual, who loses a bunch of money and suddenly they can't put food on the table, right? And at the end of the day, I guess buyer beware, but it just makes me uncomfortable that there are the haves and the have-nots, and it's gotten to a point where the haves, Keith Gill, Ryan Cohen, are taking advantage of the have-nots. And I know I'm going to get president on social media. That's
we gotta go, Anthony. I can keep. I mean, haves or haves not. I mean, isn't that the story of Wall Street writ large? And this is just some guy. I don't know. We got to leave it. Well, to be continued. To be continued.
Right. I was going to say we'll save that for dumb money too. Okay.
All right.
We'll put that in production. Anthony, appreciate all of your insights and all your commentary here. Thank you.
Happy to.
We are only moments away from the closing bell. Stay tuned for more market domination overtime.
That's the closing bell on Wall Street, and now it is market domination overtime. We're getting you up to speed on the action from today's session. So let's start with where the major averages ended on the session. Pretty much where they were last time we checked them, about an hour ago. Not much movement in the last hour of trading here, with the Dow finishing higher by about 1/5%, around 79 points. The S&P down very slightly, a little more than a point, not even 1/10% there in the Nasdaq, down just about 1/10%, about 15 points on the day. Jared, really a story today, perhaps, of people kind of waiting for the jobs report tomorrow, waiting for the next big market catalyst. We saw a lot of big moves on the individual stock level, which we've been talking about, but not as much on the sort of macro level today.
The indices, the world of bonds, also the dollar, everything pretty quiet here. So let's go to the Wi-Fi Interactive. Just take a quick look at the sector action. Consumer discretionary, that was the best performing sector of the day. XLY up about 0.75%. Followed by energy, healthcare, staples, real estate, materials, and communication services. All of those outperforming the S&P 500. To the downside, utilities the biggest loser, down 1%. And we're going to take a look at the Nasdaq here. And guess what I'm going to do? I'm going to put market cap numbers on. So once again, Nvidia, a switch from yesterday. Down a little bit, ending the day down from Apple, a little bit lower, and also off of that $3 trillion mark. Elsewhere in mega cap land, we see Amazon up 2% as it's flirting with its record highs. Costco up 1%, but not a lot of outperformers or underperformers for that matter. It looks like ARK is in the lead here among my leaders and sentiment markets. Also American, U.S. internet, Korean stocks, gambling, but not seeing too many outliers. I will check in on ARK Innovation. So we got Tesla up over 1.5% today. Hood, one of their holdings, that's up 6.5%. All in all, looks like a better day here for disruptive tech.
Where did GameStop end?
Oh, are we still doing GameStop?
Yeah, dumb money too. I'm ready.
All right, here we go. Here's our meme stocks up 47%. I'm going to show, this is the intraday chart. We had a number of halts today, but guess what? Ending near the highs of the day. And to put this into context, this is the highest close of the year and probably in several years. You have to go all the way back to about late 2021. And if I put the 5-year chart on, you can see this latest peak, well, still has a ways to go to get to anything we saw in 2021, but hey, it's a start.
We'll see if Keith Gill tries tomorrow in his live stream.
Yes.
We'll have to find out. Well, let's back it up and talk about the big stuff here. S&P 500 and Nasdaq slipping from records as traders look ahead to the May jobs report. Investors are weighing economic data amid growing hopes for interest rate cuts. For more, let's bring in Mark Baribeau, Jennison Associates Head of Global Equity. Mark, thanks for being here. So just give us big picture, first of all, as we await tomorrow's jobs report. Do you have a read on the economy that we are going to sort of like bump along here and then get cuts later this year?
Yeah, that seems to be the pace that we're moving at. You see the ADP number was a little bit slower than expected. We've seen retail sales reports that have slowed down. So I think the Fed's getting largely what it wants. Core inflation has been trending down again. So I think the market is correctly viewing rate cuts as a distinct possibility later this year.
Hey, Mark, I'm interested in your take on a couple of mega caps here. Nvidia, leader of the year. It's down a little bit today, and we got that big stock split tomorrow that investors are gearing up for. Also, though, Amazon. This is a stock that's on my radar. It's right around its record highs. It was up 2% today, but it hasn't broken out yet. We've seen a lot of its cohorts do that, but it hasn't done that yet. So Nvidia and Amazon, please.
Yeah, well, Nvidia, what an amazing story, right? Their data center business was at $15 billion 2 years ago, $48 billion last year. Consensus has it above $100 billion this year. Never in the history of mankind have we seen a revenue ramp like that. So we're in the fourth era of computing. We're moving to generative AI. It's going to change the way computing works, the way software works, everything we do. So every big shift in a technology paradigm always has that singular leader who defines the shift, and NVIDIA is that distinct leader. So, as long as the data center spending continues, not at the torrid pace, obviously, of this year and last year, but at a more normal pace the next couple of years, we think the company's going to do extremely well.
And it's interesting because there is the big question overhanging not just NVIDIA, but the whole kind of AI concept has been the sustainability of that when it comes to the growth trajectory. But it sounds like you're even if it doesn't continue quite at the same pace, the idea that there's still going to be growth in that area.
Oh, absolutely. I mean, look, the size of the installed base of data centers is just over $1 trillion. And not all of it has to convert to quote unquote accelerated computing architectures, but most of it will over the next several years. And the company that's going to gain the lion's share of the market share is likely to be NVIDIA because of its competitive advantage in scale, software, and networking. So there's real reasons why they're the big winner so far. So that's just such a large addressable market that it's hard to discount them not being successful in the next few years.
Let's talk about another large addressable market, but this time in healthcare, and we're talking about being overweight and also diabetes. We've seen Novo Nordisk, we've seen Eli Lilly surge in various fits and starts, but this seems like we're still in the opening innings here. Where do you see these companies going? Where do you see the whole movement going?
Well, I mean, the numbers are staggering. The consensus revenue estimates, I think, for Novo Nordisk, I believe, are $50 billion by 2027. And for Lilly and Nordisk, by 2030, the industry could be at $100 billion. That's the revenue estimates you see emerging now as a consensus. So these weight loss and type 2 diabetes treatment drugs are a paradigm shift, and two companies are going to largely split that market. So it's a huge, huge opportunity. And what we've seen so far is good revenue growth from both companies, but very constrained because they don't have the manufacturing capacity to keep up with demand. So the gating factor here is really supply. It's not demand. The consumer demand is off the charts. These really are consumer products. That makes them very unique in healthcare. Versus something you would take to treat high blood pressure or cancer or something very serious like that. These are consumer products, so they do have enormous potential. And as manufacturing capacity comes online, you'll see revenue growth continue to accelerate. So that's the backdrop for that industry. It looks very, very healthy.
Mark, it's really interesting because I think the AI story is pretty well, if not understood, then people have certainly bid up the stocks. The weight loss thesis, pretty well understood. Where are the areas that you're seeing as sort of emergent growth? Or where do you think are areas that are not as well understood right now?
Oh, there's a few. I mean, one of our favorites is if you look at what's going on in emerging markets, particularly in Latin America, is the boom in technology platforms that are addressing not just e-commerce, but financial technology. There's huge unmet need in the marketplace in Latin America for low-cost credit, access to banking services, through digital banks, access to goods and services through e-commerce platforms. And so it's the technology platforms that are really delivering the goods and services. It's not coming through traditional industries. So, like a Mercado Libre in Latin America is one of our favorites. Growth there is very, very robust, and momentum seems to be improving. And it's not just in their e-commerce business, it's also in their fintech business, where they do supply credit and other financial services to their e-commerce customers, to their online merchants, and to people off platform. So very, very compelling offering, and their services are throughout Latin America. Their big markets are going to be Brazil and Mexico.
All right, Mark, we got to leave it there, but really appreciate your insights and stopping by here. Mark Baribeau, thank you.
Thank you.
And artificial intelligence hype is driving tech giants to new heights, with Nvidia recently touching that $3 trillion mark. And U.S. regulators, they want a say over keeping AI markets competitive. Now, the Federal Trade Commission and Department of Justice recently reportedly reached an agreement to investigate Microsoft, Nvidia, and OpenAI. And with more on this, we're joined by Alexis Keenan. And Alexis, these are the big three names here. So what are the details?
So this is kind of a drip. We know that there has been interest in the AI area and the companies that power AI. But what this is an agreement really in principle for the US regulators to divvy up the investigative work when it comes to the antitrust front. You have the DOJ agreeing to take on Nvidia, and you have the FTC going to look at Microsoft and OpenAI. Now, no one has been sued yet. There's no complaints on the table. And we really don't know what the focus of these investigations are. So we have to hypothesize a little bit. But we know there's been concern over the dominance of too much control of the AI stack. So what's in that stack? You have to think about things like the high-performance chips, NVIDIA, cloud resources, training data, and software, and also then those end consumer products like those large language models, a ChatGPT, for example. So why would the regulators be looking at NVIDIA? Well, they control the design of these high-performance chips. They have approximately 90% market share there, also controlling the chip hardware as well as the software, so really vertically integrated. And why then OpenAI? You have dominance there in generative AI, those LLMs. Also, they're using Microsoft's resources, their computing resources, to power their technology. So you have to look at OpenAI and Microsoft as kind of this coupling, and then you, on top of it, have Microsoft investing $13 billion in OpenAI, and also paying $650 million for a licensing agreement to resell Inflection AI's products, and also hiring their staff, most of their staff. So that's looked at as perhaps, we don't know, but a deal that's maybe masquerading as a purchase, an acquisition, as opposed to just paying for those services. Now, certainly when resources like NVIDIA's chips, let's say when any resource becomes what's considered kind of indispensable, everybody's got to have it, like a smartphone.
Tesla needs 100,000.
Right, right. So that's when you have regulators stepping in and having concern. So it's not too much of a surprise if you're willing to put NVIDIA's chips in that basket for the moment to say they're going to want to make sure that enough companies, enough people have access to this technology.
You know, as you're talking, it reminds me of something that we said yesterday, which was 5 months to the day until the presidential election. These are really complex investigations that both the DOJ and the FTC have undertaken, not just in this case, but in a lot of big tech cases. Is the clock ticking? Like, they got to get it done before, I mean, you know, if there is a change in administration, Wouldn't some of these investigations potentially end?
They could potentially be dropped. We don't know. But look, the case that's pending against Google, there was a big trial, right? We're waiting for the judge's decision there in D.C.
Right, so
that
one's
was brought by the
closer.
Trump administration. So all these cases aren't necessarily, as much as we hear about the Biden administration's push on both the DOJ side and the FTC side to go after big tech, it's not necessarily going to get dropped just because another administration steps in.
Very good point.
TBD.
And good point about that Google case and when it was originated.
Yeah.
Thanks, Alexis.
Sure.
Appreciate it. A safe landing in the books for Boeing's new Starliner capsule after launching successfully on the United Launch Alliance Atlas V rocket. The space vehicle with a 2-member NASA crew docks with the International Space Station today. This first crewed flight test comes after various delays. It was scrubbed twice due to technical issues, but Boeing's successful mission turning up the heat with competitors such as Elon Musk's SpaceX. Boeing's Starliner joining SpaceX's Dragon capsule Endeavour in the space race. Coming up, the Fed's monetary policy under the microscope after the ECB cuts interest rates. We'll discuss next on Market Domination Overtime. Investors waiting on the jobs report tomorrow, and of course it comes ahead of the Federal Reserve decision next week. The backdrop for central banks around the world, the rate cutting cycle has started, led by the Bank of Canada and the European Central Bank. Joining us now is former Kansas City Federal Reserve President and CEO Esther George. Thanks so much for being here. Appreciate it.
Nice to be with you.
So let's talk first about the jobs report here and sort of put it in context. It seems to me that the Fed is still really focusing more on the inflation data, but what should be sort of the read-through from something like the jobs report?
Well, of course, the jobs report is going to be very important to this committee because they do have a dual mandate. They focus both on inflation and on unemployment. But this committee has been quite clear for some time because we've had an inflation problem in the country. And right now, even though inflation has come down quite dramatically over the last year, it remains well above this committee's target. So I think inflation is still the key indicator right now, even though both of those things I think pretty soon will be coming into better balance for what they're looking at.
I'd like to get your thoughts and comments on the ECB decision this morning. European Central Bank cut rates by 25 basis points as expected, but they were the first to do it here among the developed countries, and it's not often. It's been a long time. Another guest pointed out it's been years, decades since the ECB kind of led the charge that way on the way down. What do you read into this, just as a former central banker yourself?
Yeah, I think, first of all, I think about how inflation has really been a global phenomena. Coming out of that pandemic with the supply shock we experienced, the world experienced an inflation problem. And each country's dynamics are a little bit different as we have come through that period. And so in the case of the ECB, you look at Europe was really affected more around its inflation dynamics with energy, for example. And so as they make their assessment of confidence in where they are in their inflation fight, obviously they signaled sooner and earlier that they would be in a position to cut. And we saw that today. I think the same is true with Bank of Canada. Their dynamics a little bit different. And so the Federal Reserve is in a place right now where, given its economy, given the amount of fiscal stimulus that is there, how the economy is performing, I think has indicated they're at a peak interest rate right now and will be looking to the future of where those rate cuts come and are really in a wait and see mode right now. And I think that will probably be true as they come out of their meeting next week.
Well, and you just said a few moments ago that you are pretty confident that things are coming back into a better balance. It feels as though the data recently has been a little less even, or at least less clear that it was all going in the same direction in terms of moderating inflation while the economy was holding up pretty well. So I'm curious what data points you're focusing on that gives you that confidence.
So I have for some time been thinking a lot about consumer spending and the job market. And I think in both of those, we are seeing some moderation. The good news is the economy looks pretty good right now, that there is growth. Consumers, although some of the retail numbers have come in slower, are still spending. The unemployment rate remains low. But there are some factors around the job market that show it is beginning to come into better balance as it relates to the quits rates, for example, the number of job openings, businesses reporting that they're having an easier time hiring. All of those things I think will be important to see where they come out tomorrow, to see where the May data positions the job market, and particularly with wages. So all of those indicators show, I think, welcome moderation. Whether it is enough to continue the progress of inflation down in a timely fashion, in a way that this Fed is looking for, I think is really too early to tell exactly when that's going to come about.
Looking past the jobs report and also inflation reports, what other economic reports do you focus on to try and give you an overview of where we are, where the American consumer is, where the American economy is?
Well, I think one thing that's always interesting to look at is consumer confidence and how people feel about their current situation. And we know that inflation has really clouded how Americans feel about their prospects, even though we have really historically high employment in the country. So I think consumers, as they judge their optimism or lack of that on the economy, does have the potential to affect how they spend when they begin to pull back. So I think looking at how consumers feel, given that that is such a large part of how the economy performs, is always important. looking at manufacturing, how are businesses feeling about their prospects in terms of capital investment and other things. And of course, the other indicator I think so important right now with inflation at the levels it's at is to see what the expectations are both from the market and from households about the future of inflation. So all of those indicators I think right now are in play in terms of providing really a totality, as the Fed chairman has talked about, in data that the committee will be considering as they look and see whether their policy settings continue to be appropriate.
I share your sort of fascination with where the consumer is going here, and it seems as though there have been a number of different elements that have combined to support the consumer, particularly higher end consumers. One of those elements, ironically, is the fact that rates are where they are because there's a lot of money in money market funds, for example, that folks are then getting a return on. Stocks are rallying, which is also helping wealthier Americans. So there has been this idea floated that cutting rates, ironically, might reduce that spending power of the wealthiest cohort. Do you think that that holds water, that argument?
Well, you have to remember, and this is true always, the Fed has one blunt instrument called interest rates, and it affects different parts of the economy in different ways. And of course, that interest rate as a macro tool is designed to suppress demand. And that's why right now, I think you could argue in some sectors of the economy, people are feeling the pinch of those higher interest rates, even as other parts, as you noted, are maybe benefiting in other ways from that. And that is always true, I think, in terms of how this interest rate policy lands. What will be important for the Fed, though, is in a macro sense, they will have to see the economy slow in a way that allows inflation to continue to come down. And I think there are reasons to think that could happen. I think first quarter reminded us it may not be a straight line in terms of how that inflation comes down. So keeping a restrictive policy, being confident that that policy is going to have the desired macro outcome is really the goal for this committee.
All right. It is a big, big economy with lots of cohorts. That's my takeaway here. Really appreciate your time. Thank you, Esther George.
Thank you.
And now it is time for What to Watch, Friday, June 7th. We're going to start off with jobs. The monthly jobs report for May is coming out at 8:30 a.m. Eastern. The expectation is that the economy added 190,000 jobs last month, an increase from April's slower than expected gains. And the employment rate expected to hold steady at 3.9%, which would extend the streak below 4%, something not seen since the early 1950s. And hourly wages are expected to tick up slightly from April.
Meantime, Nvidia will complete its 10-for-1 stock split after the market closes tomorrow, meaning each share that shareholders own will be split into 10 shares. Trading for Nvidia stock on that split-adjusted basis is scheduled to begin when the market opens on Monday. Now, the move doesn't change the valuation of Nvidia as a company, but the shares will have a lower price each, making them, in theory, more accessible to investors.
And finally, the meme stock rally. It rages on. Keith Gill, also known as Roaring Kitty, is set to host a live stream on his YouTube account at 12 p.m. Eastern. Shares of GameStop, they shot to session highs on the news, closing higher by 47% and briefly causing trading of the stock to be halted because of volatility.
Imagine something similar could happen tomorrow in terms of those volatility halts. We shall see. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. Stay tuned. Hello and welcome to Asking for a Trend. I'm Julie Hyman in for Josh Lipton today. And for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. Artificial intelligence has taken the tech industry and beyond by storm, but reality is starting to set in. Regulators reportedly eyeing antitrust investigations into names like Nvidia and Microsoft as the power grid braces for a rapid surge from data centers. Plus, the return of the meme rally. GameStop stock surging after Roaring Kitty scheduled a live stream for noon tomorrow. Keith Gill, the man behind the account, is tied to recent posts on Reddit that set off a rally earlier in the week and sparked reports that E-Trade was considering kicking him off that platform. Plus, Wedbush's Dan Ives may hail the company as the Messi of AI, but Palantir's slowing U.S. commercial growth sparks skepticism that the company could fail to live up to the AI hype. Josh Lipton sat down with Palantir CEO Alex Karp to discuss the company's outlook, defense spending, and much more. Well, electrical grids across the country are feeling the pressure from the AI boom. Our next guest says something's got to give. For more, bringing in George Generikas, Managing Director at Canaccord Genuity. Thanks so much for being here, George. This is something we've been talking about a lot, right? This huge demand for AI, the huge demand for power that comes along with it. But of course, there's also a lot of talk about grid security sort of around the country and resiliency and whether it's going to be able to keep up with this. So where are the sort of the pain points in your view?
Well, thanks for having me on. So we wrote a note last week that was inspired by a report from ERCOT, which is the Electric Reliability Council of Texas. It's the organization that operates their electric grid down there. And like your other guests, probably we've written a lot about the potential for AI data centers to tax the energy grid. But what we appreciate about the study from ERCOT is it's one of the few that we've actually seen that in a granular way tries to quantify what the impact could look like. The study was inspired by a bill in the Texas legislature that demanded ERCOT analyze the impact of things like data centers on grid reliability as a winter storm in 2021 significantly impacted the grid and resulted in deaths. And what the study found that was starting in 2028, 2029, 2030, in both the winter and summer, the reserve margins, which is this buffer that they try to create to make sure that they can handle peak loads, would turn negative. And that is clearly not something that they want to do. So either they have to add significant energy generating assets to the grid, or the demand for all this AI-related hardware that people are buying has to slow down. And like we say in our notes, something's got to give there.
Well, it doesn't seem like the latter thing is going to happen necessarily, right? At least not in the short term. Are there any plans, though, in the works? I mean, I feel like for years now we've been talking about ERCOT. We've been talking about the grid problems in Texas specifically because of heat waves, because of other winter storms as well, winter weather. So is anything giving on that side?
So there are plans to add significant energy generating assets, whether it's solar, whether it's stuff with battery technology, and even longer term, we're very bullish on the potential for nuclear technology, particularly small modular reactors that'll help create baseload clean energy across the country. And we cover a company called NewScale, ticker symbol SMR, that hopefully over the next several years will start to win some contracts to build out the energy infrastructure in the United States for data centers.
And it seems like this is really a regional issue. We talked to another analyst yesterday who covers the utility industry, and she kind of said, well, it depends on where you're talking about. Maybe in a place like Texas you would have an issue, but there is sort of ample capacity in other places. I guess the question is whether data center operators are going to try to locate in those places that do have more capacity.
Yeah, that's a very fair point. I mean, in Texas, there's a lot of cheap green energy, so companies are putting their data centers there. Traditional parts in the Mid-Atlantic. We know some places in Ohio. So yes, it's kind of geography specific, but ultimately, the more data centers you add, the more EVs you add to the grid, it will begin to tax it. And I thought this particular study was alarming just because you get to this potential negative reserve margin scenario that's very, very dangerous for their grid and for the country. And so, and like I said, we followed up that note that we wrote with basically calling out some posts yesterday or 2 days ago from Elon Musk and someone else who went back and forth on X that basically said these companies are buying so much of this AI-related hardware, they don't know where to put it. And that's sort of creating an issue there too. So it's not just having to put the energy generating assets in the ground, it's also finding where to put all this AI-related hardware that they're buying. And so there seems like there's this potential for an air pocket as all these ambitious plans to create AI data centers meet the realities on the ground of building data centers, buying energy generating assets, getting permits, finding labor. This is all the real world stuff that might slow down the AI related stuff.
Right, and not to mention maybe have an effect on our electricity bills as well, potentially. Even though it is a regulated industry, we've already seen that kind of an increase. So George, as you mentioned, you kind of look at it as well through the prism of who could benefit from all of this, not just like where is it going to create bottlenecks, as you were just discussing. You talked about one idea, one company that might be poised to benefit. Are there other sort of grid resiliency operators or alternative power operators that you're looking to here?
Certainly. We cover a company called Ameresco, that basically a clean tech integrator that should benefit. Although they're not quite seeing demand from data centers yet, that we're seeing some early signs from that. Same thing for a company we cover called Fluence that hasn't really seen yet that data center demand, but they're starting to see the inklings of it. And also, if you want to buy a generator for your home to make sure that it's safe from any issues with the grid, you buy Generac, GNRC. They make the generators that basically serve as backup power for residences and for some commercial industrial applications as well.
George, good to catch up with you. I look forward to Something's Got to Give Part 3, maybe. The next update on this. This is definitely a topic that's not going away, so we'll keep talking about it.
Thanks for having me.
Thank you. The S&P 500 dips below the flat line on the heels of a record close. Investors setting their eyes on fresh labor market data. And Yahoo Finance's Josh Schaefer joined us now with more on the trading day takeaways. Hey, Josh.
Hey, Julie. Yeah, not a lot to say about today, really, because stocks didn't do much, quite simply. We're ahead of the jobs report. Tomorrow, the S&P 500 closed 1 point under an all-time high, so really not a lot happening, and I want to take a look at why that is and essentially look at what could happen tomorrow. So we have a chart here with us. This is taking a look at the relationship between Citi's Economic Surprise Index and the S&P 500. Essentially, the way to think about this chart is as our line comes down, that means that bad economic news, or when economic data comes in lower than expected, softer than expected, that has been good for stocks. This has been the trend basically over the last month here. You can see we've had fits and starts with this quite a bit through the rate hiking cycle. But I think this is just to say that over the last week, we've really seen a little bit of softer data in the labor market, not crazy soft, but the market has liked soft data. So we're looking for 185,000 non-farm payroll ads tomorrow. Maybe if we come in soft, maybe that's what the market wants, or maybe it wants a strong labor market. I don't know. But this has been the trend.
It wants everything. It wants a strong labor market, but low inflation.
And it wants rate cuts,
Lower
right?
rates, yeah. So how are, we are seeing that increase,
yes,
which is interesting to see.
It has been interesting to watch. So this is the probability of a Fed rate cut in September from the CME Fed Watch tool, currently pricing in a roughly 70% chance. Last week it was just 51. It's a pretty big move. We know these odds move a lot.
Right.
But it was interesting to me to see this big of a move in a week, really off some JOLTS data, not a lot of data. It's not like I guess we had an inflation print last Friday now, but there wasn't a ton of data, and of course no Fed speak over the week. So it's been interesting to see this move. And also, again, what does the jobs report do to that tomorrow? And what does the Fed meeting actually do to this expectation?
Yeah. I mean, you know when we're going to know if there's going to be a rate cut?
In September?
When Jay Powell tells us there's going to be. He usually signals, right? In other words, it's not going. We don't have to wait till the day of. Usually there's signaling either the meeting before or through Fed speak. Yeah. But we don't. I mean, for September, we still don't know.
And the question too is, does it matter that much if it's September or if it's November? I think that question is still.
Yeah, we've talked to a lot of investors who said it doesn't matter that much in terms of the trajectory for stocks, as long as they're not cutting because of a dramatic slowing in the economy. That's sort of the caveat. for all of this. Well, all of this boring macro stuff's going on. We still got a guy with a bandana who's going to talk to us tomorrow, apparently.
Yeah, I called this GameStop won't give up because I was talking to our colleague Josh Lipton on Monday when GameStop rallied and then it kind of cooled off. And I was like, maybe it's over. We kind of left the segment with, maybe like this is just it, right? Because GameStop had the rally on Monday. I'll pull up the chart here for us. It had the rally on Monday and then it sort of just died down after that.
Yeah.
And I don't know if I'm going to have the chart for us. I think I might have moved our chart around a little bit.
Here, I'm going to help you. I'm going to help you out here. Because I know it's the top trending ticker, so we'll just go to the top trending ticker,
we'll get
and
there.
There will be GameStop. So there's GameStop. There it is on the day.
And that's the move.
Hey, you want to do the 4-day here? So here's you on Monday saying, well, maybe
nothing's happening.
Maybe it's going to go away. And then here's you today. I'm sure there's some sort of meme to describe your trajectory throughout the week.
It's us rolling forward in the chair, right? It's the initial meme. It's, we're interested again.
Oh, okay. All right.
And the Reddit account that's attached to Roaring Kitty just posted after the close that position that he has is now up over 500. It's at about $580 million, up over $300 million from when it was opened. So pretty interesting. I don't know what we're going to hear tomorrow.
I don't know. Does he still have a fundamental case to make for GameStop? I mean, we just talked. I think you missed it, but we just talked to Anthony Chukumba of Loop Capital, who covers still GameStop as an analyst, and boy, was he fired up, and not in a good way, about what's going on with GameStop. And he said this, the business is in a much worse position than it was when this began, right? A few years ago. Let's do a 3-year chart or take it to a 5-year chart to show what, this was the first time around. And the business has only gone down in terms of the revenue, in terms of number of stores, just health of the business. And yet we see this happening again.
The final thing I'll say, I'll be curious if he mentions any other stocks. Because everything he's done so far, it's only GameStop moving. Yeah. Maybe that's how we broaden out a meme stock rally to some extent if he talks about something else. That's what I'm interested for.
Quick precision here. Anthony does not still cover GameStop, but he still obviously talks about GameStop.
We all talk about GameStop.
Yeah, it's
the fun stuff right now.
Yeah. All right. Thanks, Josh. Appreciate it. Well, coming up, we've got a conversation with Palantir Technologies CEO Alex Karp about the company's AI platform. That's next on Asking for a Trend. Palantir Technologies customer conference, AAPL, giving customers the stage to showcase how they use the company's software. In an exclusive interview with Yahoo Finance, Palantir Technologies CEO Alex Karp details the functions of the company's AI platform and what it means for investors.
I think what everybody watching this is familiar with is you have a massive hype cycle around large language models, and then when you try to use them in your enterprise, you find out that it's more like self-flagellation and it's expensive with no output. And what we learned in the context of warfighting primarily, but also across the 20 years of building software infrastructure, were how do you manage an emergent natural resource called large language models in a way where you actually get value, meaning you can transform your enterprise, you can change the margins, you can turn non-technical people into technical people. On the battlefield, you can do things that would have otherwise cost billions of dollars for millions of dollars, meaning being very precise in how you allocate troops, being precise in how you target people. There's a fundamental fallacy around large language models. People could conflate actual data of an enterprise, which is structured and can be taken apart and understood, with a large language model, which is much more like an emergent property, something that is can be modeled, used, but you need precision. And all the value in the market is going to go to chips and what we call ontology. And we have this ontology, and the ontology will allow you to take a large language model and use it, refine it, and you then impose it on your enterprise, in the logic of your enterprise, in the security model of your enterprise. And what does that mean for the 70 people are here presenting, talking about why they're using it, how they're using it. You gotta remember, we started selling this product just over a year ago. We started with the claim that we knew a lot about the precursors of large language models, and the general approach of just buying models is going to be essentially self-pleasuring for an enterprise at the cost of the enterprise. And no one believed us. And now you see 70 people saying, hey, we're using this for construction. We're using it for hospitals. The people who are not speaking, but we're using it on the battlefield. We're using it to compress margins. We're using it to build enterprises that we're only able to build in Asia, in America. We're making engineers better engineers. We're making people who are not engineers into engineers using our ontology and a large language model. And this works very, very quickly, and it is substantially changing the health and vitality of every business here. And for as opposed to the alternative, which is that you buy some large language model, you party with it basically, and the next day you have a hangover. and again, for people just looking at this, what does it mean for Palantir? It means we are sitting on the only thing that actually creates quantifiable transformational value in an enterprise. Yes, it is not understood well because everybody understands the problem incorrectly. Yes, it is going to transform America, and our clients are leading the way. And by the way, it's like to actually show things that are not understood, you have to actually show them. The whole purpose of this conference is, I can tell you how an ontology works. It's actually quite simple. You have the logic of the business, including the security logic of the business, and you have something that approximates new knowledge in a new form called a large language model. And it allows you to take the value of the new form, the raw resource of a large language model, largely powered by chips, and put it into a precise organization in the logic of the business. I can tell you that. Or I can show you 70 businesses saying, my business is stronger, healthier, and much better than any other business in my sector.
And so what is, bottom line for investors listening, Alex, how would you characterize, what is commercial demand like right now for AIP?
The way I would explain it to my most important investors, which are individual investors, there's two parts of the market that are creating value people will pay for, chips and ontology. And you understand the chip side now, and now you're going to understand ontology. And what does that mean for your business? It means you can actually use this raw resource and process it into something that actually works. And if you want to see exactly how, watch the people presenting. You're going to see people in construction using it to build buildings quicker, cheaper, more accurately. You're going to see people in the hospital industry saying, how could I possibly ever distribute my patients ethically, fairly, and commercially relevantly? How could I distribute resources across? How can I manage my company as not abstract units, but as a portfolio? These things are happening within days.
What I'm interested in, Alex, is because you can talk, a lot of CEOs will say, and they'll say it on Yahoo Finance, they're interested in AI, but actually they're not willing to pull the trigger yet because they have these questions about privacy, security, vendors. But you're saying we're crushing it, we're closing the IP business.
What I would tell any of them is,
how are you doing it?
Well, there's a technical answer, which I gave you the precursor of. But again, do you want to know how we're doing it, or do you want to enjoy it being done?
Both, really.
Great. Well, first you want to see it works. Yeah. Like the central issue, I think, we have hundreds and hundreds of CEOs. And by the way, the thing about the 70 people here presenting is, they're presenting to other people. I'm not paying them to present. The reason they're presenting is they're like, wow, I didn't really believe this could work, and now it's working really well. So the most important thing, by the way, for a normal user, someone who's going to pay, is, does it work? Then the second question is, how does it work? Does it scale? What is the commercial model? You really have to establish it works. I would stand by the thing that in this case is, people think of large language models as the value in of itself. What they're going to find is the large language model is much more like a chemistry experiment, the outgrowth of which is something that is useful when refined. And the refinement of that for your enterprise happens in what we call our ontology, which is where we impose the logic of your business on the large language model in the security and intellectual logic of your business. And this is transformative. And what it means for investors and others is, there is value in this market. You can identify where the value is very easily. Are people paying for it? Will they pay for it? And there's a Pareto optimality to a lot of this stuff. And that Pareto optimality happens when people say, oh, I am actually getting value. And that's why people are here.
Let me ask you, I want to broaden the conversation because you kind of suggested this. Just get your take on the moment we're in, because there's some, Alex, you've heard, who say, listen, this is a historic moment. Internet, mobile, and now AI. Nvidia's Jensen Huang said the next industrial revolution has begun. Do you agree with that? You agree with Jensen?
I think you're going to have very divergent. For some people, this is the next generation. And for others who think they're doing very similar things, it's going to fail.
Who defines the winners? Who will be the winners?
Well, come talk to our 70 customers. They think they're winning. And it's like, look, a lot of this goes back to basic ideas of how you build things. Why you got to talk to people who are getting value and ask them, how are you getting value? Why are you getting value? Are you paying more or less for that value than you think you should? And that's exactly what you're going to see today. You're going to see people saying, I'm getting a lot of value. It went much quicker than I thought. I'm outstripping what I thought I could do. I'm much better than the people. It happened efficiently, and I don't think they'll say this, but I'm paying less than I think I should, and that's why I'm very happy about it.
To get to the full interview with Palantir Technology CEO Alex Karp, head over to our Yahoo Finance website. More Asking for a Trend when we return. Let's take a look at what's trending after hours now. First, shares of DocuSign. We're watching those go down about 6% after the company delivered first quarter results. Earnings did beat Wall Street estimates, but second quarter billings guidance missed the street's expectations. DocuSign also boosting its stock repurchase program by up to $1 billion of outstanding common stock. And we're also watching shares of Vail Resorts, ticker MTN for Mountain. The shares down almost 6% after earnings missed analyst expectations, and the ski resort operator cut its full-year EBITDA outlook. That guidance missed estimates as well. The CEO saying the lowered guidance was a result of lift ticket visitation not rebounding for the spring season. Well, that's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.